There is a survey that has been running since 1960. Every month, researchers contact ordinary people and ask them the same questions. How do you feel about your financial situation right now? Are you planning any major purchases in the months ahead? The answers get compiled into a single number, one line on a chart. That line has never been wrong. It fell before the 1973 downturn, before the 1981 recession, before the dot-com collapse, before 2008. And this is the critical detail. Not after 2008, before. The line moved first and the crisis arrived later. In December 2008, and the absolute floor of the worst financial collapse in a generation, the Conference Board's version of this index hit 38, an all-time low. In May 2026, the University of Michigan's version hit 48.2. The Conference Board version sat at 93.1, soft enough that the only comparable readings in the last 20 years appeared in one specific period, around 2008. See, here is the thing about consumer confidence that most coverage completely misses. It is not measuring how people feel about the stock market or interest rates. It is measuring something much more basic than that. It is measuring whether ordinary people believe their financial situation is going to get better or worse, whether they feel safe spending money or feel they should protect what they have. And that distinction matters enormously because consumer spending drives roughly 70% of economic activity in developed economies. When the line falls, people are not just reporting pessimism, they are describing behavior. Think about it this way: when you genuinely believe your income might fall or your job might disappear, you stop buying the things you were going to buy. You cancel the trip and you delay the car. And when millions of people make that same decision simultaneously, the businesses that depend on those purchases make their own decision. They order less and they cut costs, and the spiral that was already in the data becomes the headline. The University of Michigan index at 48.2 in May 2026, all-time low. The conference polled at 93.1, comparable to pre-2008 readings. And both of these sitting in an environment where cost of living pressure, weakening saving rates, and job uncertainty are already compressing household budgets before any official recession has been declared. The line is not reflecting a crisis that has arrived. It is reflecting a population behaving as though one is coming. But consumer confidence alone does not make a crisis inevitable. Every major financial crisis in the last 100 years, 1929, 1997, 2000, 2008, was built from the same five structural conditions. And these five were identical. Prices completely detached from what assets actually earned. Today, major AI sector stocks trade at 50 to 100 times sales, while real commercial adoption lags years behind those valuations. Borrowed money sitting underneath those prices. US margin that hit $1 trillion in 2026. $5 trillion evaporated from retail leverage positions in a single March 2026 checkout. US economic composite indicators hit 0.84 in first quarter of 2026. That number appeared once before at that level in 2008, after the crisis had already begun. Right now, it is appearing before. The pattern has a track record that does not have exceptions. The five conditions assembled before 1929, before 1997, before 2008, and the economist who publicly called the 2008 crash 3 years ahead of consensus is now saying a recession this year is almost inevitable. The Consumer Confidence Survey does not know what the headlines will say next month. It simply records what millions of ordinary people believe about their own financial futures when nobody is asking them to perform optimism. And right now, for only the second time in 64 years of recorded data, it is sitting at the floor. The first time it sat there, the crisis had already broken before the reading arrived. People were not anticipating something, they were living inside it. What the 64-year record actually shows is not that consumer confidence predicts crisis with perfect precision. It shows that when ordinary people simultaneously shift into protection mode, the pulling back becomes widespread. The line has moved, and the checklist is assembled.